Steve, a couple of weeks ago we were talking about Realty Income and we said we didn't think they had anything left that they could do, and we were very interested to see what they would go out and acquire. And midweek they announced they're acquiring what, on the face of it, looks like some petrol stations. Steve, was this what we meant?
Yeah, there was a nice picture of some petrol stations. If it's the case that your emergency fund means that you sleep better at night by being bigger, you must be getting close to 15 hours by now. Yes, Realty Income. So for anyone who hasn't heard that bit of that show or can't remember what we said, I took the view of Realty Income. I own it. Steve doesn't, I think. Paul absolutely does, because he's a dividend growth investor, whatever that means, and it is the law that you have to own Realty Income if you are a dividend growth investor. But I own it, and I said, look, from my perspective, here is what I consider to be the big risk. It's difficult for this company to grow very much. They have a fairly unspectacular portfolio of assets. They're pretty undifferentiated compared to some of their competitors. They have high quality tenants in there, which means they're very likely to get very good rent collection stats and very unlikely to be able to do significant price pushing on them, because high quality tenants can go to other places that are basically equivalent. So the wonder with Realty Income is, how does this company grow? And it's a REIT, so it's hard for it to go acquiring things, but it pretty much has to. And yep, it's gone acquiring what in the picture you sent, or the picture that I think they have on their thing, appears to be a bunch of petrol stations. What it is actually convenience stores, and they have a 1.5 billion sale and leaseback agreement from a bunch of convenience stores whose names I did not write down because they didn't mean anything to me, but they describe them as the leading convenience chains in the northeast, I think, of the US. Never heard of most of them because I don't live there. But they've acquired 415 convenience stores. They have a 6.9% cap rate on them, cap rate being the net operating income over the asset value, judged however you wish to judge that. They have a 20-year average lease attached to them. This is pretty on brand for Realty Income, from what I can tell. It looks to me like one of the things that they talk about a lot as a company is, because they're a retail REIT, you would want them to talk about this, what their plan is for dealing with the fact that, look, e-commerce is coming. And their main part of their strategy is to try and buy stuff that is some way protected from the onset of e-commerce. So stuff like Cineworld, never mind. But things like gyms, things like convenience stores are a good example, to be honest. There is still a strong sort of sense in which people kind of whip out to the shops to grab something quickly, and they don't just Amazon or Tesco or whatever in everything. You might do your big shop elsewhere, but not your kind of we've run out of milk, go and get some type thing. So that's pretty on brand here. The bit I couldn't work out when I was trying to figure out whether this is a good deal or not, they paid 1.5 billion for this. I couldn't see how this was getting funded. I hope, in my head, that it's being funded with stock rather than debt. And I hope that for a couple of reasons. One is because it would make the kind of value investors who think that a high and rising share count is always a bad thing go absolutely mad, because this will almost certainly involve dilution. The other is because, as far as I can tell, their cost of equity is going to be lower than the 6.9% they'll get. And this is basically what they do. You print equity at one price, you buy stuff that's going to generate cash at a higher price. That's pretty much what anyone does, to be honest, when they're funding something through equity. But in this case, it's rental income. So you try and hope that, look, the amount you're sending out is lower than the amount you're going to pull back in. And that makes it a good deal. They have a pretty good bond rating. It's A3. It's from Moody's, that is. That's investment grade, I think. But I wouldn't mind seeing them funding this with stock. I'll keep an eye out for if I see anything telling me how that's happening. It's set to close in the second quarter of this year, I think. So in the next sort of 3 months or so. Steve, did you get much off of this? You sent me a nice picture of a petrol station, but anything beyond that?
To be fair, when I sent it to you, I'd not even read it. I just said it didn't look good because I don't like petrol stations. But I have since read it, yes, and it actually looks like a fairly decent deal to me. I'm the same as you. I think that debt would be a bad thing for them at the moment, and I think they'll try to avoid raising any kind of debt. I think this is going to be an equity issue because they're getting a decent return on this. It looks like a no-brainer to me when you look at the list. Providing this company can continue to pay its rent, it looks like it probably probably will be able to. This is a decent little bolt-on acquisition to the side of Realty Income, which is actually going to bring in a decent amount of Realty Income's overall rent. So it is a nice needle mover for them. One of the things that I've always wanted to bring up with you, Steve, and I always forget, is when they span out this other REIT, this office REIT, why on earth didn't they put the cinemas in it?
It's a good question. I don't know on that, because it was around sort of COVID-y time, wasn't it? And you would have thought that was a decent chance to get all the kind of garbage off the books as well, because they clearly wanted to shift towards what they consider to be a retail-heavy portfolio. I'm not really sure what I think of a cinema as. I mean, I don't think of it as retail in the sense that it's not really a shop, although they sell stuff in it, I suppose. But it's also not an office in any meaningful way, as far as I can tell. That would have been a good opportunity to get rid of that stuff, wouldn't it? I hadn't given that much thought before, but it would have been nice to kind of offload that. I guess they felt fairly positive about it, but that's been the most obvious example of what is a fairly low-quality tenant that they have. And I suppose in fairness to their kind of broad approach, that's gone kind of wrong. There's sort of two ways you can go with a REIT of this type. You can either look for high-quality tenants and then find you have no pricing power, but they'll probably pay, or you can go for low-quality tenants, try and gouge them, because where else are they going to go, and then find they go broke, or risk them finding they go broke, basically.
Yeah, and this is the thing. I was looking at it. It's about 3% of their portfolio now is in cinemas, and you think that's quite a decent amount of, rent that you could potentially lose. I mean, they've got more in cinemas than they have with people like Home Depot or Kroger or Tractor Supply or even people like CVS. I mean, you get into the sort of scale of like Wynn Resorts. It would be like losing a Wynn Resorts, and cinemas to me look like they're in awful shape. So. I just can't believe they didn't spin this off. To me, this would have been one of those ones that I'd be like, oh, you just shove that in the bottom of the pile, spin that one out. But they seem to have wanted to keep it. I wonder what it is that they see in it.
Would you have turfed out gyms as well, out of interest?
I probably wouldn't, no. And gyms are a smaller part of their makeup. I was just looking at the makeup now. Gyms are only 2% of their makeup. So I think gyms, especially with LA Fitness, is a pretty decent established company, which I think is probably going to be on the up. Whereas cinemas and AMC are almost definitely, it's Regal and AMC as well, which are two that have particularly performed particularly badly. They're definitely on the way down. They would have been ones that I've been looking to get rid of rather sharpish.
Yeah, interesting. So I mentioned this as a dividend growth stock. Here's a question for you, see if you can guess at this. I mean, the real kind of question mark in my mind is how many of these kind of acquisitions can they do? Because I don't think they have much capacity to push prices. And time will tell on that. I mean that genuinely as a point of uncertainty, not as a kind of, oh, they can't do anything, who are they going to buy? I don't know who they're going to buy. They could buy all kinds of things. But that would be the kind of big question mark in my mind that stops me kind of blindly lumping into Realty Income.